Joining us right now to talk about the market impact of all of it is Jason Trennert. He's the chairman and CEO of Strategas Research Partners, which is a Baird company. Jason, this is up, up, up and away. And I wonder how you're feeling about things. Are you in the camp that thinks, OK, still, you got to throw your towel in with this and go along with it? Or are you in the Jamie Dimon camp? He certainly sounded a little more concerned about things.
Well, listen, I'm the one thing I'm having a hard time reconciling is if I look out at next year, the earnings expectations are for up 12, revenues up 5, and also 4 rate cuts. And I just historically that's a tough thing to pull off all at the same time. Generally speaking, the Fed funds rate doesn't have a rounded top. As Art Cashin says, it takes the stairs on the way up and the elevator on the way down. So that's the only kind of hesitation I have. Is just that people are really calling for an almost perfect scenario where you get a slowdown in inflation, but still very rapid earnings growth. And I think that might be a hard thing to pull off in 2024.
Look, I'll go back to this. I know you have been in this camp of thinking that things were going to come down for a long time. The market has evaded any sense of coming back down. But I will also say, back to Jamie Dimon, when he spoke with Andrew yesterday at DealBook, he was pretty concerned about the idea that this could be a sugar high. Is that what you're kind of buying into? Because when Jamie Dimon says things like that, I certainly sit up and pay attention.
Well, certainly, listen, and I don't want to make this overly political, but this administration is pulling out every rabbit out of a hat it can, whether it's the Strategic Petroleum Reserve, whether it's the bank lending facility after Silicon Valley Bank, whether it's the fact that we're running a budget deficit that's close to 6% of GDP at full employment, which has never happened in the post-war period. The only period the only times we've run deficits this high were when the unemployment rate was already over 7, and the unemployment rate is now under 4. So, if we're not for the government being so munificent or incontinent, depending on how you describe it, it seems to me it would be the economy would be in tougher shape than it is right now. And you have student loans, you have the employee retention tax credit. I mean, there are a lot of things being thrown at the economy to keep it out of recession at any cost. My only issue is that comes with a cost, right? And generally speaking, over time, the cost is higher inflation.
So what are you doing? Are you sitting on the sidelines? Are you waiting for a pullback? Are you investing in areas that you think will do okay anyway?
Yeah, no, I think, and listen, we haven't had a wholesale, we've been certainly cautious and bearish, but I mean, we've also been focusing on areas of sectors of the economy that are not up nearly as much as tech or the Magnificent Seven, but do have a very positive spread between their earnings weight and their market cap weight in the index. So financials and energy, as an example, financials, I think, going into next year could be interesting place to be. We haven't been overweight that this year, but we've been overweight energy. And there are very big differences in terms of the bang you get for your buck in the index. Whereas if you look at the Magnificent Seven and you made it a separate sector, it would be 28% of the S&P 500, but only 17% of the earnings. Whereas if you look at energy is only about 4.5% of the index, but it's about 12% of the earnings. And so from my perspective, going into next year, that's where we would like to be. We want to be in places where, again, you're getting more bang for the buck as far as the weightings in the overall index.
Like energy.
Like energy a lot. I think, and I know it's part of the reason why I like it is that I believe, just based on my travels, and especially abroad, it is institutionally underowned. No one owns it. That's partly for political reasons. It's partly because in the past, those companies tend to light money on fire. But I think it's different now. I think there's a lot of new capital discipline among the majors, the public majors, that I haven't seen in my lifetime. And they're very focused on return on equity and returning money to shareholders. That's a big difference. The other thing that's interesting about energy is that it tends to be counter-cyclical as far as regulatory oversight is concerned, which is to say they tend to do better during periods of intense regulatory oversight. The stocks do better.
Right.
Donald Trump loved the energy sector. and they were terrible. Biden hates it, and they've been terrific since he was elected.